The other thing I alluded to earlier was the GIPS rated standards. GIPS stands for Global Investment Portfolio Standards, okay, not system, standards. It's an international portfolio, and I have an article here. And when you fill out the card later, if you just write GIPS on the line, we'll send you a copy of the article if you want to have a copy of it. GIPS is an international standards organization, kind of like ISO for manufacturing. This is GIPS for investments. 20-some countries are involved, and another 15 or 20 are coming in. And it's not difficult to be GIPS rated. You just have to be committed to gathering information and sending it in. So we are GIPS rated and proud of that, and we're glad to share more information about that with you. And there's one more announcement. In your statements, if you are a client, you received information. The second page was about a symposium that's coming up in August. How many of you saw that when you opened your statements? There's a symposium coming. There are a couple of speakers that I'll highlight for you. Terrence O'Dean, UC Berkeley. He's a behavioral economist. I've heard him speak. He's very good. He gives us a lot of information. He's part of the board, the advisory board for Matson Money. He'll be speaking at this symposium. David Booth is the founder, CEO of Dimensional Fund Advisors. You don't get David Booth to speak anywhere. David Booth, for his name, is University of Chicago, the Booth School of Business. This is the David Booth that built that school in the university in Chicago. And David Booth and Mark Matson are good friends, and David is going to be speaking at this symposium as well. Art Laffer, how many of you know who Art Laffer was or remember him from the 80s? He was one of the economists that advised Ronald Reagan. He's on the advisory board for Matson Money as well. He will be speaking at this event. And Darius Rucker, a.k.a. Hootie, he's not going to be doing any speaking at the event, but he will be performing. You all probably know who Darius Rucker is. He's a great performer and is very popular. I think he's gone country, right, more recently. So he'll be there. These are some names that you may want to check out. I've benefited a great deal a couple of times a year going to a conference that we choose and hearing a speaker on one topic or another. I try to do this once or twice a year. So when Mark Matson puts something on, I try to attend because the speakers are very good. The event is good for another reason for me. It's sometimes good for me to get away so I can think. You know, you get involved with your life and your work, and sometimes you really start to think when you're out of town. This will be in Cincinnati, and you can just spend a night and get back in 4 or 5 hours after the event is over. And it could be a good time for you to think. You could do some of that visioning while you're there as well. So if anyone is interested in coming, you have to be a client to attend. I'm going to try to put a block of rooms together, and I'll be there. One thing I'll mention, it's being held at a casino. I think it's probably because they needed a very large venue. I probably wouldn't have chosen that. And just so you look at everything, you know, if I recommend a book to you, I don't agree with every word in the book. You recognize that. So just understand there are some things that make me a little less comfortable. But I think for the most part, I appreciate those. I appreciate those speakers that'll be there, and I'll be going. I know a few clients that are out of town are going to be going. I have a couple of clients in Louisville, and they're going to try to make it. So I'll be there. We're going to try to do a dinner. So if you're interested in that, email me afterwards or write symposium on your card, or casino. If you just write casino on your card, that'll make me feel really comfortable, and then we can talk about getting together down there. So I'm going to get started on Love the Bear Market, and I thought, you know, we're going to talk about something, and I planned these obviously in advance because I think at the last seminar I said we're going to be doing Love the Bear Market. I wonder, you know, the market was down in January. If you remember, it was quite a ways down. So I thought, you know, maybe there's going to be another bear market coming. We don't know these things. But then it fully rebounded, right? And today I think we were up again another 100 and some points in various sectors, small companies and large, a number of percent back to the good again. But then it struck me, you know what? We're going to talk about the bear markets anyway because it is never the right time, as we just talked about in the last presentation, to plan for a bear market when you're in it. There's a way that you should act in a bear market that it is precisely correct, and then there's a way that you can act in a bear market that's panicky or incorrect. And so we're going to talk about how to handle bear markets. Now, first of all, bear markets versus bull markets. Is everyone crystal clear on what a bear market is? And if not, I'll define it for you. A bear market is a down market where the stock market is down for a prolonged period of time. I think they say 3 quarters. So 9 months. If you have a 9-month period where the market is down, you technically have a bear market. In one of my email invites, I talked about January being a little bear cub. And would this bear cub grow up to be a full-grown bear or not? We don't know, right? But we want to be prepared whatever it turns into. And then the converse of that is bull markets. There are specific activities that the prudent investor does or doesn't do in bull markets as well. So we're going to talk about bear markets, and the reason we're going to do it is because another one will be coming. We've had, I don't know, what did they say, 11 such bear markets since the 20s? And those who acted this way fared very, very well and did not have to look at the stock market as a thing to be predicted, but could look at it as something to be used for their benefit. Jason Zweig, and the impetus for this entire presentation came from a 2008 article. He says a bear market is a gift from the financial gods, and the longer it lasts, the better off you will be. Instead of running from it, you ought to embrace it. Okay? And part of me likes a bear market, believe it or not. I didn't used to. And if part of you doesn't get a little excited when the market plummets, then I'm not doing my job. Now, I'm not saying all of you. I don't like a statement with less money on it last quarter than this quarter. I'm not a fatalist. But if part of you doesn't get a little excited, then I'm not doing my job, and you're not seeing markets correctly. This is a little picture. We've got a girl. I want to bring out the girl with the daisy in all of us, okay? We want to just make friends with the big, ugly bear. And again, now's the time to do it when we're not in the middle of one. This is one of the longest bull markets runs we've been on. It's been 61 months, 5 years and 1 month. Started in March of 2009. Now it's April of 2014. It's not the largest. There have been 3 longer bull markets. But if this one passes the last one, which I think was in the 80s, you're going to start to hear a lot of hype about how much longer it could last. And it could pass and become the longest bull market in history. I think it'd have to go another, I don't know, there's 6 years beyond this before it would be the longest in history. But if it becomes longer even still than it is today, you are going to hear a lot of hype about it. There are going to be panicky people telling you to get out, get out, get out. And we're going to tell you in this, by contrast, we're going to tell you how to act in this bull market so that you're prepared for the next bear market as well. Warren Buffett says, if a stock I own goes down 50%, I'd look forward to it. In fact, if you could guarantee me that that was going to happen, I'd pay you a tidy sum of money, he says. Right? If in the next month you could guarantee me that all the stocks I own were going to go down, Warren Buffett would love to pay you a large commission to have that information in advance. What's he essentially saying there? He believes that the stocks are, in the long run, they're going to go up, right? And he believes that the short run drops are just that, short. And unlike just about anything else we buy, Warren Buffett understands, and this is where I want you to kind of feel good about a bear market, and I'll show you why inside your own portfolio you should. But he wants to buy stocks when they're low. Why shouldn't we, right? Buy stocks when they're on sale. If you already have stocks, you want to buy more of them. And the bad news about the stock market isn't that bad. The bad news is there, though. Exactly 10 years ago from when this article was printed, that would have been 1998 to 2008, the Standard & Poor's 500 index was at 1164. It closed Friday of July 2008 at 1239. That's an increase of 0.63. We've talked about this period, this rough 10-year period that's anywhere from negative 1% a year to positive 1% a year, depending on when you start and stop it. And this is Jason Zweig's article, so we took his dates. And that's bad news, right? We can't build a retirement on 0.63 per year. We certainly wouldn't ride the ups and downs of the market for 0.363 per year, right? I'd get off in this train pretty quick. But not all asset categories act the same way. They don't all act the same way. In your book, if you want to see them, you can open to this page. This is an encouraging page. For this, we just chose a 25-year period from 1988 all the way through the end of 2013. The S&P 500 during that period of time was over a 10% return. Fama French U.S. Small, so the U.S. Small Company Index, was nearly 16% during that 25-year period of time. The U.S. Large Value, so value companies, low-price stocks in the United States, were 11 point something percent. The deciles 9 and 10, that means small companies, in the United States, nearly 13% rate of return. The EFI index, the EFI value index, was the international value companies, 7.5. The EFI growth companies, over 6. And the emerging markets index, over 12. Now again, you had to be in it to get these returns. You couldn't have started and said, hey, I'm going to own this one for the right period and then jump to this one. You're going to get that wrong. And sure, the S&P 500 for a 10-year period of time didn't do so well. But had you been a prudent investor over the last 25 years, and had you been at least 50 or 60% in the stock market, you would have neared a double-digit rate of return if you remained diversified the whole way through. And that's not something that we have a tendency to believe or think. That hasn't generally been our experience. The other good news about diversification, we didn't talk about it a great deal in the last one, is this reality that when you own two different asset classes, they move in different directions, right? We call that correlation. My wife and I are highly correlated in some ways. It could be good and bad. You know, there are sometimes spenders and savers. My wife and I are both spenders. We have to put lots of restrictions in place and set ourselves up for success because we know that about ourselves. We're highly correlated in that way. Okay, there are some things that are different about us or different about different things that we act dissimilarly, right? And those are the hard things we have to live with. You can look at stocks and you can say, okay, which direction do stock categories move in? This is the engineering and science behind mutual fund diversification that really gets exciting for a numbers geek like me, and should be relatively exciting for you as well, because this is the reality that says you can take on riskier asset classes and reduce your overall risk. Because these asset classes don't all have their bad years in the same year. Okay, they have their bad years in differing years. And these correlation numbers tell us the low correlation. Take this international value index as it intersects with the small value US index. You can see in your booklet too as a 0.620. Now anything that has a high number close to 1, those are highly correlated. They move in the same direction. But the lower that number gets to 0, the closer it gets to 0, the less correlated they are, and the different movements are starting to be seen. And we know these charts for any period. We know the low correlation, and we can build a portfolio based on knowledge of this, so that we can build a portfolio that has some emerging markets in it and has some US large in it, because we know that those don't tend to act the same way. So we can reduce your volatility. One of the common mistakes that we see when we analyze portfolios is that as someone gets older, and you've probably done this in your 401k if you're over 50, you get older and you start to reduce the amount of small companies and international companies and emerging market companies that you own in your portfolio. That's the only move you make. You say, okay, those are the really risky parts, emerging markets and small companies. So I'm going to reduce the amount of those that I buy. And when you do that, you make your entire portfolio riskier. That makes sense? Because you're reducing something that offsets something else. So when you take away this one, now all you have is this one. And rather than having those two asset classes that offset each other, you're not getting those correlating benefits. This is something that if you're new, I'll go over in depth if we analyze things for you, and just exactly how much correlating benefits you're getting inside your portfolio, because you can actually increase return expectations or premiums without increasing risk commensurately to it, because of this correlating reality, because of these asset classes. So when someone writes an article, essentially, like Jason Zweig, and he rightly looks at this and says, yeah, the S&P 500 has been horrific, 1%, 0%, negative 1% over a long period of time. That's not the whole story. The prudent investor is diversified. Now, you take a period of time like 95, 96, 97, 98, these years. We talked about that in the last presentation. These were really good years in the U.S. large stock market, particularly tech stocks, right? Many people, including myself during that time, uneducated in investing as I was nearly 20 years ago, I began to remove diversification. I began to chase after the returns of the hot stock class. The internet's here. Companies don't lose money anymore. They've got the internet, right? They just have bad years, which are 2%. They don't really go down. Well, the NASDAQ went down 80% plus or minus. And I ended up much of my investments there. I jettisoned prudency I got rid of some of these small companies that were in my portfolio beforehand. I ended up losing a lot more than I should have in the early 2000s because I didn't pay attention to the science behind correlation um, and dissimilar price movements. So he goes on to say, we've been in a bear market for years. The Dow was almost 600 points higher in early 2000 than it is today in 2008, and that's true. The question is, how did Matson Money advisors fare during the same time period? Well, we have it here. This is a 13-year period, beginning of 2000 to December 2012. So 13 years. We did it for the 10 years previous, 5 years ago when this first came out, and now we're continually updating this. Look at this second column here, aggressive growth, net of fees during this period of time, 105% total return, turns $10,000 into $20,000, just about a 7% annualized rate of return during that dead decade. That doesn't feel dead to me. Turning 10,000 into 20, almost 20,500, almost $21,000 doesn't feel dead to me. That's a good rate of return. You can see some good growth in your retirement there. Long-term growth, net of fees, just over 5, turning 10,000 into 19. Balanced growth, this is that 50-50 fund. It's a moderate fund. 50% stocks, 50% bonds, net of fees, 4.25%. We have a lot of folks who have retired into this column here, and during one of the worst decades in history, they still were able to pull that 3 or 4%, or even if they took 5% without a great deal of loss in their portfolio. There's a good income coming to an investor here. And then income and growth, 25% allocation to stocks, and 75% allocation to bonds, nearly 3% growth. And again, compare that to the S&P 500 with a total return of almost 7 during that period, only 0.5% per year. It grew 10,000 to 10,681. There's almost no return in that myopic single investment portfolio of just U.S. companies. We'll do the net of fees one here. This is all in the graphic form, the same numbers that I showed you before. So 0.5% in that one asset class, but the diversified investor did far better. And we're right here, we're actually cherry picking a pretty bad period of time. We're bad cherry pickers. You cherry pick as an investment advisor, you can show really good periods of time. We're actually cherry picking a very bad period of time. When I analyze a fund, Steve would agree with this. In general, 50% of the fund is in U.S. large companies. 50% of the fund is getting that kind of treatment. Maybe there's a little bit in bonds and a little bit in internationals. Sometimes it's 60, 70% is in large U.S. companies. The average investor during that 12-year period of time, mostly because of the 90s preceding it, went through that period of time in large U.S. companies only. That was their experience, and it was a very poor one. Part of what causes us to be jaded about it. Pictorially, you can see that dark blue line on top is the aggressive growth. The light blue line on the bottom is the S&P 500. Folks achieving this, lots of volatility, low payoff. Why would you stay in the stock market if this is your experience here? It's just not worth it, right? There's no reason to be there. And yet if you can remain prudent during the whole time, there are definitely premiums to be gained for investors during this very negative period. Being diversified can be extremely beneficial. Yet investors are doing exactly what they know to be what they shouldn't be doing intellectually. They know that they shouldn't be buying high and selling low, but that's what they're doing when they see the market drop and they panic and sell what just went down, right? U.S. equity funds, the net redemptions in 2008 were $278 billion. Those are net redemptions from the U.S. equity funds only. So we know that investors, by and large, when the market tanks, investors sell. Not everyone, but many investors sell. We have net redemptions to show for it. Dimensional fund advisors and Matson Money, because the clients are very well coached, had net increases. Now, investment account balances did come down, and a little bit more for the aggressive investors, but there were net new inflows of money, which means more people were putting money in. And that's the benefit of coaching. That's the benefit of having someone building up that cognitive for you over time. The investor's chief problem, and even his worst enemy, is likely to be himself. This was written by Benjamin Graham in the late 40s, early 50s, when he wrote his book, The Intelligent Investor. Jason Zweig quoted him. And what are you being bombarded with and harassed with daily? There is still hype. Talked about some of this. The author's discussion on avoiding the diversification trap is alone worth many times the price of this book. Diversification trap? We just looked at the undiversified fund having gotten about a 0.5% return. The diversified one, 10 times that. And Gene Marshall is talking about his 7 commandments of stock investing and saying that there's a trap somehow. So this hype is still out there. Being a real estate millionaire. Dean Grassi, what did I read on this? Secret strategies that you can, oh, this was funny. Reading this amazing book will change your life. Call now to hear an important, free, recorded message from best-selling author Dean Graziosi and find out why. So here's a guy that's going to change your life, and he has pre-recorded a message for you so that you could find out why that's going to be true. That must be impactful. Jim Rogers, a bull in China. He's standing over China there, I think. He's the Indiana Jones of finance. I'm not sure I want Indiana Jones handling my... the Indiana Jones of finance, what has that got to be about? I just picture Indiana Jones running in front of that big, huge boulder, right? And he's diving, and is the boulder my money? Does Indiana Jones have my money in the little satchel, and it goes to the guy who takes the weird head? I don't know. I'm not finding an Indiana Jones analogy that I like, but anyway. The horror, the headlines. This was from a 5-day period, July 16 through 20. Consumer prices driven by fuel, surge 1.1, 2008. So again, in the middle of your horror, in the middle of your accounts going down, Democrats see a need for future further economic stimulus, New York Times. Obviously, the Republicans didn't stop them, so I'm not sure why the Democrats took the bait for that one. But stocks soar on drop in oil prices, Wells Fargo reports. Fed chief bleak on economic outlook, seeing bad loans, investors flee from bank shares, opposition from both parties over bailout plan. Here's one that says stocks are going to soar on July 20. July 16, the Fed chief is bleak on the economic outlook. Where do we turn, right? In 5 days, we see 5 horrific headlines, all of which leave us with really no apparent understanding of what we should do next. Fearmongers, George Soros, one of the worst. The credit crisis of 2008 and what it means. It's a new paradigm for financial markets. Crash Proof, Peter Schiff. Peter Schiff is the big gold and silver guy. He's been quieted a little bit in the last few years. How to profit from the coming economic collapse. Schiff has been talking about a coming economic collapse over the last 25 years, and you saw what taking that advice, keeping you out of diversified equities would have given you there. How Wall Street caused the mortgage and credit crisis, the chain of blame. The biggest offender probably, Howard Ruff. How to prosper during the coming bad years, a crash course in personal and financial survival. Now we're about to lose it. His number 1 recommendation was sell stocks and buy gold. Surviving and winning in the inflationary 80s. Making money, author of How to Prosper During the Coming Bad Years, Winning the Battle for Middle-Class Financial Success. $20 at a time with his book. How to Prosper During the Hard Times Ahead. What's it like to be married to this guy? He is a negative Nilly. Safely prosper or really rich, choosing your personal financial heaven. Heaven. Now it's an updated version. Bad years are coming for the unaware. Wouldn't the bad years be coming for everyone? It's just a bad year, right? It just comes whether you're aware of it or not. But when you know what's really happening behind the scenes, okay, then you can make the best of your the best years, make them the best years of your financial life. Then he says it's deja vu all over again. It's a little redundant. Only this time they're even more exaggerated, offering once-in-a-lifetime opportunities for middle-class Americans if they look beyond the Wall Street stock market propaganda, gold, silver, certain ETFs, mutual funds, and mining stocks. So he's going to pick stocks for you again. Howard Ruff, New York Times best-selling author. So we look at gold and we look at equities and we look at their track. This is a returns track that kind of gives you the sense for how volatile these are. Gold is in green, kind of flat for a while, then kind of volatile here. The S&P 500 is in blue, maybe a little more volatile than gold. Certainly small companies are more volatile. Okay, positives and negatives. Certainly with small companies, much more on the positive side than on the negative side. If you look at the rate of return for the last 88-something years, U.S. Consumer Price Index, this is a measure of inflation, the CPI, just under 3. The 1-month Treasury bill, just right around inflation. This is a guaranteed investment, U.S. T-bills. Gold gets about a 4.73% rate of return. U.S. equities, 10%, large companies, and U.S. small companies, 12.4. So is gold a good idea? Gold is a commodity. It's expected to get the return of inflation, pretty much, and that's what it's getting. This goes through 2013. Time. Things I must endure and things I must experience. As an investor, a prudent investor who wants to achieve the long-range returns that the stock market offers you, you must endure certain things, you must experience certain things, and so long as you act prudently through them, the down markets are part of what you need to be using, you can achieve a very, very good rate of return, double digits in your younger years, and as you get older, high single digits are very well possible. The market has given that over the last while. And so Jeremy Siegel writes a book, Stocks for the Long Run, a definitive guide to financial market returns and long-term investment strategies. This is a book I would commend. There are very few written that are worth reading, but this one is. So the 3 simple rules again: own equities and fixed income assets. If you're young, you can own just about all equities. If you're closer to needing the money, or the money is imminently going to be used by you, then you want to move in some fixed income. So rule number 1, diversify. Even our most conservative clients still have 25% of their money in the stock market. And in all of those categories, we don't start to dive out of some. We keep the mix similar all the way through. Equities are a hedge against inflation. Fixed income is a hedge against the capital increases and downturns. Number 2, diversify among the asset categories. So we've identified 18 asset categories that the University of Chicago tells us over the last 80 years get the very best returns. And we know what their correlation movements are. And the engineers beyond that, behind the scenes, have built these portfolios to optimize the rate of return and minimize the risk in every category, and then periodically rebalance your portfolio. Buy asset categories in the portfolio that are down, relatively low, and sell when they're higher. So in 2008, when the market started to plummet, and it came all the way to its bottom in March of 2009, the stock market, if you measure it by the Dow or by the S&P 500 or other forms, from top to bottom went down nearly 60%. And it was a panic sale. I mean, just about every category went down during that period, about 60%. And that, if you want to say how close is that to the Great Depression? The Great Depression went down about 69%, a well-diversified portfolio. So we're pretty close. This was 2008. And at that time, all of our investors sold fixed income because fixed income had gone up during that period of time. So we're looking at short-term bonds as the fixed income diversifier. That's what brings stability to the portfolio. And it rose. So we had gains in fixed income. We sold off those gains, and we bought stocks. That's rebalancing. We didn't do it in March 9 because we thought, hey, March 9, that's the bottom of the market. It was like 3 days before the bottom of the market. We didn't do it because it was the bottom of the market. We did it because your portfolio was 2% out of scope, and that's our trigger. We had done it 3 or 4 times down the hill. So we constantly are selling the asset class that's doing well, and we're purchasing the one that's doing relatively less well. So given that, what have we been doing the last 5 years? Selling what? Selling stocks, right? What have stocks been doing ever since we bought more shares of them all the way down the hill into through March? They've been rising. And that means if you have a 50-50 fund, so 50% stocks, 50% bonds, that means that if you didn't do anything, you'd be going up that hill. Stocks are having a good run, and maybe stocks would become 60% of your portfolio. And what if I didn't do anything about it? Did you get older or younger during the past 5 years? Closer to retirement or further away from it? Closer. Did your portfolio get older or younger if I did nothing? It got younger, right? it became a 60-40 fund because the stock market went up very, very well over the period, and the bonds did less well. They also went up, but they didn't go up as high. So what must I do while the stock market's rising, sometimes 30% in 1 year? Well, we're selling off those gains and we're protecting them by buying the investment class that did less well. That's rebalancing. Rebalancing is not going in to see your financial advisor and saying, I don't like Europe. I want to rebalance out of Europe. That's not rebalancing, that's panicking. That's making an emotional decision. Rebalancing is where you say, hey, I made this decision to be a moderate investor or an aggressive investor, 75% stock ownership and 25% bonds. If that's who you said you were at this age, then yeah, if the stocks become 80% of your portfolio, you need to sell off that 5. Now, we don't make our clients do that. We do that for them, but that's what we're doing. And we do every once in a while have a client call and say, hey, the market's way down. I'd like to become more conservative. We can do that once, but if you do it then and then you want to become more aggressive when the market's up, we'll give you your money back if you're going to do it, because that's market timing. And if you remember, my GIPS rated returns are an average of all of your performance and all of your behavior, right? I'm not willing to sacrifice GIPS rated returns for your panic or your misapplication of what the right thing to do is. And most of the time, you don't need to make a move. By most, I mean 99-point-something% of the time. We're going to help you remain disciplined, help you get the money back. But now again, we're in a bull market. Now is the time that if you've gotten older in the past 5 years, and raise your hand if that's you, okay? If you've gotten older in the last 5 years and you haven't revisited with me or your 401k balance in a while, and said, hey, I'm now another 5 years closer to retirement. Maybe I should think about scaling back. Maybe I've been growth and I ought to be more moderate. Take an honest assessment of yourself and make a decision to do something about that now. Now is the time to do that. But these are the 3 rules: periodically rebalancing, and this is how it works. Overall, remain disciplined over an entire lifetime. Make these decisions at the right time. So this is the reason I bring bear markets to you at a time like this. In your booklet, you have all of these categories. I'm handing that booklet to you, so I'm not going to go through each one of these numbers for you. You can see most of them in your booklet. I think there's some fill-ins there. But you can see that even in a conservative account, where most of the portfolio is in fixed income, nothing greater than 5-year government bonds. We're not going long bond or mortgage. These are risky. But we're even in the small value companies and the international small cap companies for the most conservative investors. Very small percentages of the money are there, but we're still there because of the correlation charts. Pictorially, this is what it looks like. I think this is in your book as well. And then I'll go through one of these and then just make the point. In fact, I'll go through the growth mix. This one is closer to an average of all of you. This is called the investing vortex. And as you can see, the longer someone holds the portfolio, the closer in the orange and the blue line come to the pink line, right? Just visually, that's what you're seeing. This isn't one of those where I'm going to say which line is longer, the pink line or the blue line. We're done with perceptions. But 9.8% is the net of all fees return that is expected in the portfolio growth mix. So in the portfolio that has 75% allocation to stocks, 25% allocation to bonds, fixed income, this is the expected long-term rate of return. Now, if you hold this portfolio for 1 year, you could see a return 38% that year. You could see a return of negative 22. This is 95% of the outcomes are going to be in here. So you could actually see a return higher. You could see a return lower than that. Not very likely. But if you hold the portfolio for 2 years, now the average return of those 2 years, you could see an average of those two get much better, between negative 12 and positive 33. We don't mind positive volatility, right? These are the negative volatility. This is the line we want to stay away from. And we have a better chance of staying away from it the longer we hold our strategy. Because the longer you hold your strategy, if you hold your strategy for 10 years, then this is a 10-year period, and you're very unlikely to have anything happen that's over 10 years negative. 95% of the results, it's actually, in the last 40 years, it's been a higher percentage than that. that have been in the positive sector, and it's closing in on this pink line. And if you looked at the distribution of results tend to go here, and then they just kind of close in right on that pink line. The longer you hold your portfolio, the more likely you are to achieve your long-term expected premium from the market. I'll show you what most clients or most investors do. They start over portfolio A. 3 years later, they change strategies. They go to portfolio B, and they have a brand new starting point. 3 years later, they change strategies. They go to portfolio C. They have a brand new starting point with a wide berth, and they never give themselves the benefit of getting into close and close to that pink line. And the average investor in equities does around 4.25. Part of the reason is they're changing strategies constantly. Part of the reason for that is that they've been not given enough of that cognitive information to know what to do, and they haven't been coached to remain disciplined over the period. We have a historical events chart that's pretty interesting. I don't know if you can read that in the back. I'll read some of them. The Great Depression, Pearl Harbor, Soviets detonate a nuclear bomb, Korean War, Sputnik 1, Cuban Missile Crisis, go down the list, JFK assassination, and the date that it happened, and the return of the markets, the month of the incident, the 1-year return, the 2-year return, the 3-year return, the 10-year, the 20-year, and the annualized return from that incident. Okay? These kinds of incidents that give us pause, the 9/11s, the JFK assassination, the Nixon resignation, where we have a mistrust, right? They tend to have a negative effect on markets the month after, oftentimes. Not always, but oftentimes they do. But in the long run, returns are generally always, again, very positive when you remain disciplined through and around that whole thing. Many people will jump out of the market if they feel uncomfortable if something happens. 9/11, I mean, they closed the stock market for 3 days. How many days was it? 3 or 4 days? I think they closed the stock market because they just didn't want this huge run, right? But when you pull out of the market, you end up with a brand new question that you have to answer. And that is, when do I get back in and how? Because you know you can't remain in cash or T-bills forever, right? So the information says, stay in, remain disciplined. The best defense is a good offense. That picture makes me a little uncomfortable. I didn't pick it, to be honest. It's Steve. It's my brother. I'm kidding. It's not Steve. He's got a long reach. I wouldn't want to box him. It's Jack Dempsey's quote. The best defense is a good offense. And a good offense is rebalancing. And in a bear market or in a bull market, that's what we're going to do for our clients. And so what I'd like to do is go through a couple of cards that you have in front of you. I promise always to make this educational. I don't want to make this salesy, but I do want to give folks an opportunity. And what time is it here? It's 8:03. So I'll give you these 20 must-answer questions to take on your own because we got started late. I don't want to keep you here too late. But do take a minute, if you would, and fill out this card. On it are a few boxes you could check. Yes, I want to meet with a qualified financial coach, or I want to meet with my coach. If you're a client of mine already and for whatever reason you want to meet, I may have given you 2 or 3 reasons that you want to do that tonight. You are always welcome to do that. We have just hired a marketing intern, David. He's over there. He's been making some calls. You probably heard from David Van Dyke. He made a ton of calls in the last week and a half. Our mantra is ruthless compassion. We want to call you 4 times a year because we don't want you to have to remember to call us if something happens in your life. So please don't take our phone calls as pressure to come to events or as pressure to meet. Please take our phone calls as ruthless compassion. We want to be where you need us rather than hope you'll call if you have an issue. So we're going to call you 4 times a year, 3 or 4, and we want you to feel comfortable to meet with us anytime. You can always check that box. If you're new or you've been invited to come and you want to meet with a coach, you'll meet with me, either in person or on the phone, whatever your preference is. And that meeting is free. I'll talk with you for 45 minutes to an hour, and we'll just ask questions of each other. I'll answer all the questions that you have at that point. We call it an investor inventory. I understand your situation, and I ask some questions and see what kind of comfort level you have with it. We're trying to find a good match. And again, I'm not interested in meeting with folks. If you're sitting here and you're looking for a market timing financial advisor, you already know you're not going to fill out the card, and that's okay. I can't be who I'm not. But do take the time to do that.